A meeting happens behind closed doors. No cameras. No applause. No election banners. Just a long table, printed charts, and decisions that will affect millions of people who will never hear the discussion. This is not a government meeting, and it is not a market transaction. It is a central bank decision. Most people think central banks exist to manage inflation, or to stabilize employment, or to protect the currency. That's not wrong, but it's incomplete. Central banks decide how stress is distributed when the system comes under pressure. Every modern economy runs on promises. Banks promise deposits will be available. Companies promise debt will be repaid. Governments promise bonds will be honored. Markets promise prices will reflect reality. Not all promises can be kept during a crisis. Something has to give. Central banks exist to decide what breaks first. Before central banks, financial systems failed loudly. Banks collapsed. Currencies disappeared. Credit froze. Central banks were created for containment. A lender of last resort. A buyer when no one else would buy. A source of liquidity when trust evaporated. But containment has a cost. Once a central bank intervenes, someone is protected, and someone absorbs the loss. This choice is framed as technical, neutral, independent, but it is structural. Lowering interest rates changes the price of time. Borrowers are rewarded. Savers are penalized. Capital is pulled from the future into the present. This works until it doesn't. When the system cracks, central banks face a choice: allow collapse now, or intervene and delay adjustment. They always choose delay, not because it is ideal, but because the alternative is politically explosive. During crises, central banks become the market. They buy government bonds. They buy corporate debt. They buy mortgage securities. Private risk becomes public. Losses do not disappear. They move. Large banks are protected. Sovereign markets are protected. The core is stabilized. Asset owners recover first. Wages lag. Inflation erodes purchasing power. This is called price stability. The public experiences cost pressure. Over time, central banks manage expectations, forward guidance, credibility, narratives. Words move markets. Markets stop asking what the economy is doing. They ask what the central bank will tolerate. Risk is priced by policy. Exit options shrink. Raise rates, and debt breaks. Lower rates, and bubbles grow. Do nothing, and instability builds. Central banks do not eliminate risk. They choose where it accumulates. This is why independence matters. When confidence in markets fails, people look to central banks. When confidence in central banks fails, there is nowhere left to look. This is not a prediction. It is a structural limit. Central banks control timing, not outcomes. Adjustment is delayed, not avoided. Stability is not free. It is paid for by someone, somewhere, later. Central banks are not villains, and they are not saviors. They manage a system that cannot admit its own limits. The real question is not whether central banks are powerful. It is whether the system they protect can survive without needing them to do more every time. Because when stability depends on constant intervention, the system is no longer stable. It is suspended. And suspension is not balance.